Hey guys, and welcome back to the Matt to Million channel. In this video, I'm going to be covering how can a funded trader get a mortgage and also some of the biggest mistakes and key considerations that are often left by the wayside. So I'm going to be running through a few of those key things to make sure that you are prepared and at least have a good grounding to know what to expect when you're planning for your mortgage. I am asked this question actually on a daily basis, so hence this video being made now, so I hope it can really give some context to those of you who are considering your options. Now, this video is going to be intended for funded traders and also people who are maybe considering the funded route but are a little bit confused or worried about what it could do to the mortgage lending capabilities, and of course people that have just got an inherent interest in personal finance and are starting to take this more seriously. So if that's you, you're in the right place, stay tuned to hear more. And if you aren't interested in personal finance, then I don't really know what to say. Just tap the like button on your way out. Now, as with all of these types of videos, I do need to confirm the obvious. So I am not a mortgage advisor, nor am I a qualified financial professional. Everything in this video is just based on my experiences and perceptions, and for me to present things in a way that I wish maybe I could have found on YouTube as a point of interest and grounding so that you can take that forward in your onward search. As with anything, every single person's situation is different, so you should always consult a professional within their respective field before making any of your final decisions. Okay guys, so I'm going to jump straight into the good stuff, but as always, if you are enjoying the content on this channel, please just tap that likes up button. It goes a huge way to supporting me and this channel. Subscribe if you haven't already, and make sure you got that notification bell turned on so you don't miss when I post my next video. Okay, so let's talk house. Now I'm just going to highlight a few things that I've assumed for this video just to make sure that we're all on the same page before we get cracking. First of all, as you can tell from my accent, I am going to be talking from a UK-based perspective, and I am going to focus this as if you are a sole trader or individual that is looking to go ahead with a mortgage rather than somebody who is running through a limited company. Now the limited company is arguably a better or the easiest choice, but there are many restrictions and changes that have happened in the UK over the last 12 months that are restricting business bank accounts, and so therefore this would be covered in a separate video. But if you are interested in hearing about the nuances and the difference with the limited company, please leave a comment in the section below and I'll be sure to make another video surrounding this. And the final two assumptions that I've made is that you are buying this place for yourself and you are funded or are planning to be funded with one of the retail prop firms like FTMO, Funding Talent, or My Forex Fund, something like that. Now, in order to start, and the thing that most people are interested in is how much wonga will the man lend you? But first you're going to have to get your own personal finance house in order so that you can accurately and objectively understand what your options could be. As you are self-employed, you will 100% need to supply at least 1 year's of fully submitted accounts before you can apply for a mortgage. Previously, back in the day, you used to be able to submit this via an SA100 paper form via photocopy or whatever, but now with the latest advancements within the HMRC, a lot of this can be predominantly done online, and you can also download your summary online too. And of course, if you are working a job alongside your funded account, then you should be submitting your self-assessment anyway, but you will absolutely need to have the full year at least to be able to get that factored into your mortgage application as well as your normal salary. In any case, you will always be needing to submit your self-assessment, but remember, you will need to submit a full year, and this can only be done by showing earnings between April to April in the full fiscal year. Of course, if you started throughout the middle of the year, you would still need to declare this, but obviously it wouldn't be reflective of what you could earn or will earn in 1 year, and they won't be prorating it when you submit that to the mortgage application. So in order to demonstrate your full 1 year earnings, this will need to be a complete year from April through to April. Key point here is that although there are lenders that will accept 1 year's worth of accounts, they are limited. In a lot of cases, and the rule of thumb is essentially 3 years of accounts is the one that most companies will look at favourably. Naturally, with lenders that will accept 1 year's of accounts being limited, you will need to expect to pay a higher percent on your mortgage rate, but that is something that we're going to cover later on in this video. Now, the next factor, and one that is really overlooked, is what determines income. Now, there are a lot of misconceptions out there and potential naivety too, so we're going to try and break that down and provide my thoughts on this overall. Now, often we're surrounded and caught in the same cycles of conversations where people are just so adverse to paying tax that they're always looking for every single way that they can so that they can keep as much money as they earn. And this usually comes in the form of utilising your expense options and then making sure that you only pay very little tax based on the remaining profits after expenses. However, your year of accounts or your considerable earnings from a lender's perspective is your net profit before tax. In other words, it's not the total figure that you earn, it's the figure that you have left after expenses. So let's say you earned £120,000, but you had found ways to try and alleviate your tax by expensing around £40,000 worth. Your actual registered earnings earnings in terms of your year of accounts and submissible for the mortgage would actually only be 80,000. So yes, while you would have saved yourself £16,000 in tax on the £40,000 that you had expensed, this has also lowered your registered salary just to £80,000. So what's the problem with that? Some people tend to ask, and simply put, it's because the lenders look at the 80,000 in terms of what they're willing to lend you. As the lenders tend to multiply that annual figure by a certain amount to determine what they feel, broadly speaking, would be the max loan that they'd be able to provide. Now, it's common for mortgage lenders to offer anywhere between 4 or 5 times that figure, with the average I think being around 4.5 and the higher lenders actually going right up to 6. So let's run a quick example, and let's say that the lender is going to offer you 5 times your registered salary. Now let's say you hadn't been tax efficient at all and you had declared your entire earnings of £120,000. Obviously that multiplied by the 5 times they're willing to look at as a potential loan that they could give you, it would offer you potentially £600,000. But if you did go down that expense route and you did try and avoid as much tax as possible and you expense that £40,000 leaving you with an £80,000 salary, this would mean that at 5 times that, the mortgage lender would only be really looking at a max mortgage amount of £400,000. Now of course this only really becomes a big factor depending on the size, location and value of the house that you're actually looking at buying. But by saving that £16,000 in tax, you've essentially cost yourself £200,000 in terms of a potential mortgage loan. And what I mean by that is that let's say you have 3 years of accounts and for 2 years you try to avoid as much tax as possible, and then for the final year you decided to declare absolutely everything to try and improve your chances of getting the mortgage. But this doesn't always tend to be the case, and you can end up doing yourself an injustice. And this is because banks have their own opinion in terms of what they're going to take from those years of earnings. Some banks do believe that the most recent year is the most powerful determination of what you're earning. Others will take an average over the 3 years, so they would just add all 3 of the years up and divide by 3, and then they would use that as the figure that they're going to multiply to look at the potential upper end of the loan they could provide. And the other thing to consider is that some banks will factor in how risky they feel the profession is, therefore not actually factoring in 100% of the earnings figure that you've presented. They may see that as too much of a risk, and then they decide that they're going to take 70% of that figure and they'll work out your potential loan based on that instead. So in short, I would say that you're probably best off finding a consistent middle ground with your expenses and taxes so that there isn't too much fluctuation and that you can present that and you've got a much firmer idea in terms of what you could get lent in the future. Now, the loan itself and the maximum amount that could potentially be lent isn't where it ends, as the other factor that they take into big account is the affordability per month, and the monthly amount is going to be heavily affected depending on what percent or rate you get on the mortgage itself. Simply put, the banks tend to determine their percent risk that they're putting on the loan based on how risky they perceive you as a person that they would lend the money to. Now of course different factors can sway this, deposit being one, and we're going to run through that in just a sec, years of accounts and consistency of accounts being another, along with spending patterns, the type of house and the geolocation of your home included too. But just because you could get potentially lent something, it doesn't mean that you could afford it on a monthly basis, depending on what percent rate they apply to your loan. Generally, the comfort zone tends to be that if your mortgage only accounts for around 33% or less of your gross monthly income, then it does provide suitable affordability / breathing room for you to be able to accommodate changes in conditions. And the change in conditions is measured by the bank with something called a stress test. So what is the stress test? Now the stress test is something that's become a lot more prominent since the '08 crash, and it's where banks will essentially run some hypothetical scenarios to really understand that if interest rates were to go up, for example, would you still be able to meet your payments? In essence, just forward thinking, because really up until the '08 crash, the housing market had just been on an upward trajectory for decades and nobody really believed that they could ever crash in value. Now you'd be surprised actually how much difference a small increase in the interest rate can make on the monthly payments. And given in this line of work, it's a very niche and sometimes determined a riskier profession, you're always going to be paying slightly more on your APR than let's say your average Joe that's working a standard office job. Now of course this can be manipulated depending on how much you're earning versus how much you're wanting to borrow, and also how big your deposit is. But in general, just have that in the back of your mind that you aren't going to be paying whatever you put into the comparison site as the lowest rate. And just to give some visuals on this, let's just run through a couple of examples. Here you can see that it's a £400,000 loan on a 1.5% rate and also over 25 years, and that results in £1,600 per month repayments. But in the spirit of the stress test, let's see what would happen if that interest rate went up to 2.2%. Just a small increase of 0.7%, which may seem insignificant, then pushes that monthly price up to 12,735. And if it were to go up to 3%, you can see that it would push it to just under 1,900. So as you can see, even with just a small increase in the percentage rate, it can make a massive difference in terms of the monthly fee. And in this example, it's pushed it up by nearly £300 by going from 1.5% to 3%. And this is why the lenders do the stress test, because they want to see that you've got some breathing room around the amount that you're paying on your monthly repayment, so that should interest rates rise, you would be capable of paying it if push came to shove. So the actual potential loan and the amount that you thought was the max that you could get lent may no longer be applicable depending on how you stand up to the affordability checks and the stress tests. Now, of course, this video isn't really going into the ins and outs of mortgages, and there are different ways that you can bring the cost down by extending the term, for example, but I'm just using these flat examples to give you an understanding of what you need to demonstrate and sorts of things that you can run and scenarios in your head to make sure that you know you're going to be able to cover things. Now, the other big factor that's taken into account when assessing affordability is, of course, going to be your deposit. Now, ultimately, the lenders just want to know that if everything's to go up the spout, that their initial capital is always going to be protected. So how much you put down can really affect this assessment for them. And as a self-employed trader, I would say that you need to be benchmarking at least a 20% deposit, especially if you are lacking the years of accounts. Often, and depending on the lender, you will start receiving more preferential interest rates the higher that your deposit goes. And this has to be viewed in 10 to 15% intervals. So for example, if you put down a deposit of 5 to 15%, you get X rate, and if you put down a deposit of 15.1% to 30%, you get Y rate, and then so on and so forth. And the other reason that I like that 20% figure is if you consider the latest financial/housing crash of 2008. In the UK, and it was worse in parts of America, the average house price crashed 18.45% from their highs at the end of 2007 to the lows at the start of 2009. So if this is deemed as the worst crash of our generation, then they know that with a 20% deposit, should this happen again or something similar, they've still got a high probability of coming out relatively unscathed. But as mentioned a couple of times, if you do have fewer years of accounts or your personal finance credentials aren't the greatest, you're always going to have to expect to pay more than the average Joe Bloggs in terms of your percent rate on your mortgage. Yes, increasing the deposit can improve this somewhat, but it will be down to you to make that decision on how you want to allocate your capital and what will be the best use of it. Now, the final couple of key factors that you're going to need to consider are spending patterns and credit score. Now, spending patterns may seem like common sense, but you'd be really surprised the amount of people that overlook this. Given that this is quite a niche industry and that you are a funded trader for a prop firm, you want to make sure that anything that is in your control is completely squeaky clean. So preparation and foresight is absolutely key on this one. Now, you will need to present at least 3 months bank statements. And if you are running your prop firm profits through a separate account, you will probably need to disclose both your personal bank account and also the bank account where your prop money is being paid into. And whilst 3 months is the most common, it wouldn't be beyond the realms of possibility for them to ask for 6 or 12 depending on their assessment. Another one on this one, and to be prepared, is that they will likely ask for your invoices that you've sent to the prop firm too. So in FTMO, if you are regularly sending out those invoices, it is paramount that you keep them and log them somewhere so that you can always produce these when needed. So here are some of the key things that you need to make sure apply to your spending habits. 1, as much as possible, make sure that your spending is consistent month on month. 2nd, make sure that your spending is reasonable. 3, you're not going out and buying massive luxury items like there's no tomorrow. So key things here could be cars, watches, clothes, holidays, anything that is really extreme, whether you've paid it in full or on finance, but often the finance products can really count against you. And of course, no silly moves with online gambling or online casinos or anything like that. If you can demonstrate a consistent, measurable and sensible approach to your spending, you are going to be fine. And finally, the credit rating, and this will be considered greatly. As a rule of thumb, a score of 730 to 800 on an experience score is probably going to be suitable to be able to be accepted from that front. Other companies will allow lower scores, and this will depend on the lender, but often this will be factored based on what caused the lower score, i.e. was it constant defaulted payments, was it late payments, and also how long has it been since the last problem. If it's been 1 year, it's going to be viewed a lot differently than if it's been 5 years. This is why in any case, and with this being a unique situation, especially with a lower credit score, you'd really want the loan to be manually underwritten. This means that they will actually look at the credit score and all of the components to it, and they will make their own judgment and put their own context on it to see whether they feel it's a risk. This saves them from just making a binary decision based off of a score that gets sent through, because often you can get your score weighed down by things that are maybe 4 or 5 years ago, and a lot of lenders may decide that that isn't a big issue for them at this time. And the other bit of key advice is I always think you're better off going with a mortgage broker that can find you deals suited to your situation. Different brokers focus on different areas. Some find things for people with lower credit scores, some people find them with limited companies, some that are self-employed or have more complex tax returns. It's always great to go through those guys because they can tailor your application and they already have the personal relationships and experience of working with certain lenders. Okay, so to summarize, make sure that you've got at least 1 year of fully submitted accounts. Don't overkill your expenses if you are looking to get a larger mortgage. Save enough for at least a 20% deposit. Allow a buffer in your budget on your house hunt so that the stress test won't rule you out. Remain consistent and sustainable with your spending habits. Be abundantly aware of your credit score and how you can improve it if need be. Don't make any silly purchases on the lead up to your application to your mortgage, during the application for your mortgage, or even before you've actually moved into the house. And finally, always consult a mortgage advisor to be able to help support your application and see if you can get your mortgage manually underwritten, as it is still a relatively new, unique / niche industry to be in as a funded prop trader. If you've gained any value from this video, guys, then tap that likes up button and I'd love to hear your comments in the section below. But if I don't speak to you before, have a cracking week. I'll catch you on the next video. Take it easy.